Welcome to our exploration into the source material today. We're diving into a legal overview titled Financial Crimes of Public Officers.
Yeah, and our mission here is really to help you navigate these specific and honestly often surprising legal boundaries that govern how officials handle money in contracts.
Right, because most people, they think a crime only happens when the money is actually gone, like a follow the money situation.
Exactly. But in the world of public office, you might be surprised to learn how early that point of no return actually hits.
It's way earlier than you'd think in the private sector. The system doesn't just sit around waiting for the bank account to hit zero.
No, essentially treats the intent to corrupt as the corruption itself. It's like a preemptive strike, because in the eyes of the state, once a certain line is crossed, the public trust is already broken.
Regardless of whether the government has lost a single cent yet.
Exactly.
So let's look at fraud against the public treasury. Usually, fraud implies a victim has already been cheated.
Normally, yeah. But here, the focus is entirely on the agreement to defraud.
So, if an official uses their position to enter an agreement intended to cheat the government, but the deal falls through.
Before any money even moves, they are still on the hook.
Wow. So no money changes hands, but it's still a crime.
Right. It's what the legal texts call being consummated early. The crime is legally complete the very moment that agreement is made.
The handshake is the crime.
Exactly. The law views the handshake as the finished act. And it's the exact same logic applied to illegal exactions.
Break that down for us, because that's not just straight up stealing, right?
No, it includes a public officer demanding fees that aren't authorized or, simply failing to issue an official receipt.
Wait, failing to issue a receipt? That sounds like a paperwork error, not a felony.
You'd think so, but not in this context. If you demand a convenience fee for a permit.
Even if it's not on the books.
Right. Even if you plan to put that money straight into the office coffee fund rather than your own pocket, you've committed an illegal exaction.
Because you're operating outside the architecture of transparency.
Exactly. By not issuing a receipt, the law assumes that money is effectively off the grid. And that is a direct strike against the integrity of the office.
So the harm isn't necessarily the lost funds, it's the lack of transparency. That is a really high bar. But let's pivot a bit, because messing with the government's money is one thing. What about when an official plays the market with their own money?
You see this with prohibited transactions and speculation. It specifically targets appointive officers.
Okay.
They're strictly restricted from speculation, think regular high-volume stock trading for profit when that trading falls within their specific jurisdiction.
So if I'm an official overseeing environmental regulations, I can't be day trading renewable energy stocks.
You absolutely cannot.
Even if I don't technically have any inside information.
Doesn't matter. The system wants to ensure your official decisions aren't being swayed by your personal portfolio's performance.
It's about removing the temptation entirely.
Right. Which leads us to the possession of prohibited interest, which is perhaps the most rigid rule of all.
Okay, let's test that one. Say a mayor needs a new bridge built. His brother owns the absolute best construction firm in the county.
Okay.
They're the cheapest, the fastest, and they have the best safety record. If the mayor signs that contract because it is genuinely the best deal for the public, has a crime been committed?
Under this legal framework, yes.
But there's no fraud. The public got a great deal.
This is the critical insight from the source material. Actual fraud is not required for a conviction here. The law isn't looking for a bribe or a kickback.
So the mere possibility of a conflict of interest is the crime.
The mere possibility, it's about the potential for corruption, not just the act itself.
That seems like a total no-win for the official. They act with total integrity, but they're guilty just because of a personal stake.
It's about preventing the very architecture of a conflict from being built. The law isn't judging the outcome of the deal, it's judging the existence of the interest.
It creates this massive buffer zone around public funds.
Right, where your intent and personal interests are just as punishable as the actual theft.
It really reframes the whole concept of public service. For you listening, this underscores that public integrity isn't just about being honest.
It's about avoiding the situations where your honesty could even be questioned. It's a standard of accountability that private citizens just never face.
Which makes me wonder, if the legal system considers the mere possibility of a conflict a crime for a public officer, how would our private industries change if they were held to that same standard?
Like big tech or high finance.
Exactly. Imagine them operating under that early consummation rule, just something to mull over on your own until our next exploration.
Today, we are opening up the official rulebook, the one that draws that hard line between public service and personal profit. We're going to break down the exact laws designed to stop corruption right in its tracks.
So, this is the big question, right? When does a side deal or a little side hustle for a public official actually cross over and become a crime? It's a line that can seem blurry, but the law is surprisingly clear. Let's find out where that line is.
Okay, before we dive into the specific articles and legal jargon, we have to get our heads around the core principle here. Being a public official isn't just a 9-to-5 job. It's a position of trust. And that trust is supposed to be protected by a really strict set of financial rules. So let's see what happens when those rules get broken. All right, let's open our rulebook to the first chapter, Article 213. This one gets right to the point, tackling some of the most blatant forms of corruption. We're talking outright fraud against the government and illegally taking money from the public.
The first major offense in this chapter is fraud against the public treasury. You know, simply put, this is when a public official uses their power to cook up a shady deal involving government contracts or money. It's basically an inside job to cheat the system.
So, for a prosecutor to make this stick, they have a 4-point checklist. First, is the person a public officer? Simple enough. 2, did they use their position, their title, to get an advantage? 3, was there an actual agreement, a deal, to defraud the government? And number 4, and this is the kicker, did they intend to do it? It's a really clear roadmap for a conviction. And listen, this part is absolutely crucial. The crime happens the second that corrupt agreement is made. The government doesn't actually have to lose a single dollar. The law is targeting the conspiracy itself, because it's the plan to defraud that completely shatters public trust. Next up, in Article 213, we've got something with a fancy name, illegal exactions. This is all about public officers whose job is to collect money, like taxes or fees. This crime is all about demanding more than you're supposed to or collecting money in a way you shouldn't. So the law actually breaks this down into 3 very specific forms. The first one is the most obvious, just demanding a higher fee than what's legally allowed. The second is a little more sneaky, collecting the right amount of money, but then just not issuing an official receipt for it. And the third is when an official collects something other than what the law requires, say taking goods as payment instead of cash.
So you might be thinking, how is this different from just regular old swindling, or what the law calls estafa? Well, it all comes down to one little word, deceit. For estafa, you have to use trickery or lies. So if an officer just straight up demands more money, that's illegal exaction. But in a real case, a municipal treasurer who lied to trick people into paying more for cattle registration, well, that lie pushed it over the line into estafa. Deceit changes the whole game.
And don't think for a second that failing to issue a receipt is a small thing. It's not. There's a major case where a deputy sheriff was found guilty of illegal exaction for that reason alone. He collected money while on the job but didn't provide the official receipts. The rule is simple and absolute. If you collect public funds, you have to provide proof. Okay, let's turn the page to the next chapter, Article 214. This one builds on what we've learned and deals with officials who don't just commit fraud, but who specifically use the power and influence of their office to pull it off. Think of Article 214 as a kind of penalty multiplier. It says that if a public officer commits a crime like swindling and they use their official position to make it happen, they're going to face a much tougher punishment than an ordinary citizen would for the very same crime. And just like before, the law gives us a super simple 3-part test. 1. Is the person a public officer? 2. Did they use their position as a weapon, as leverage? And 3. Did they actually commit fraud? If you can answer yes to all 3, boom, Article 214 kicks in. So what does this actually look like? Well, real case law gives us an example of a town councilor who used the influence and the credibility that came with his title to commit estafa. Because his official position made the crime easier to pull off, he was held to a higher standard and got hit with those extra penalties. All right, let's shift gears a bit. We're moving from outright fraud to a different kind of financial foul play, conflicts of interest. Articles 215 and 216 are all about stopping officials from getting tangled up in business deals that clash with their public duties. Now, Article 215 is very specific. It focuses on appointive officials. These are the people who are appointed to a position, not elected. And it forbids them from getting involved in speculative businesses, like flipping real estate or day trading stocks, within the area where they have official power. Now, the law draws a really important line here. Just buying some stock and holding on to it as a long-term investment, that's usually fine. But constantly buying and selling stuff to make a quick buck off of price swings, that's speculation. And for these officials, it's a big no-no. The whole point is to keep them focused on their public job, not on playing the market.
Then we get to Article 216, which takes this whole idea and makes it much, much broader. This rule is about stopping officials, and some other professionals, from having any personal financial stake, direct or indirect, in any contract or business that they could officially influence.
The law is super clear about who's on the hook for this one. First, any public officer who has to officially weigh in on a contract. Second, experts like property appraisers. They can't later have a financial interest in property they valued. And third, guardians and executors, who are forbidden from having an interest in the property of the people they're supposed to be protecting. And there's a classic case that makes this crystal clear. A municipal mayor was found guilty because he got directly involved in leasing out fish ponds that belonged to the very town he was supposed to be leading. I mean, it's the textbook definition of a prohibited interest. And this quote from a court decision really gets to the heart of it all. No one had to prove the mayor actually cheated the town out of money. The law steps in because of the mere possibility of fraud. The goal here is to completely remove any situation where an official might even be tempted to choose their own wallet over the public's interest. Okay, so we've been deep in the legal weeds, walking through the chapters of this rulebook. Let's pull back for a second and just look at the big picture. Why is all of this so incredibly important? At the end of the day, every single article, every legal test, and every penalty we've talked about is there for one reason: to make sure that decisions are made for the public good, not for personal gain. These laws are meant to be the absolute bedrock of our trust in government. And that leaves us with one last, pretty challenging question. We've seen that the rules themselves are actually quite clear. So, if the rulebook is written this plainly, what does it really take to make sure it's enforced? It makes you wonder, doesn't it?
Welcome back to the Deep Dive. Today, we're doing something a little bit different. And honestly, I think a little bit daring.
Yeah, that's a good word for it. Daring.
Right. Because usually we're looking at, tech trends or historical mysteries, maybe a biography of someone famous. Mm-hmm. But today we are looking at a stack of legal texts.
Which I know sounds
dry.
Yeah.
Sounds incredibly dry, like dry enough to start a bonfire.
Exactly. But it's actually not.
No, it really isn't. Because when you actually open them up, when you start peeling back the layers of all that legalese, it reads like a manual for navigating a minefield.
That is a very evocative way to put it. And honestly, it's not far from the truth at all.
Right.
Legal texts, particularly penal codes, are often viewed as boring right until you realize they are essentially a catalog of human behavior.
Yeah, usually the worst kinds of human behavior.
Exactly.
So to give you a clear overview of what we're tackling, we are looking specifically at the Revised Penal Code, Chapter 3.
Articles 213 through 216, to be exact.
Right. And the reason I say it's like a minefield is that this isn't just a basic list of, thou shalt not steal.
No, it goes way deeper than that.
We all know you can't rob the vault. We know you can't run off with the bags of cash. This is way more specific. This is about the misuse of power. It's about the handshake, the sweetheart deal, the receipt you didn't write, or even the stock you bought at the wrong time.
Precisely. If you look closely at these articles, you realize the law is doing something fascinating here. It is trying to wall off public duty from private greed.
Yeah.
But it's not just punishing the act of corruption. It is trying to punish the temptation.
The temptation itself.
Yes. It's trying to punish the appearance of something going wrong long before the money actually disappears.
And that is the theme that really jumped out at me while going through these sources. It's not just about the money disappearing.
Right.
It's about the misuse of power. So our mission today is to decode these 4 specific articles. We're going to look at frauds against the treasury, illegal exactions.
Which always sounds terrifying.
It really does. And we'll cover prohibited transactions and possession of prohibited interests.
And for anyone listening who thinks, well, I'm not a politician, why should I care?
Yeah, why does this matter to the average person?
Because understanding this is understanding how the system is actually supposed to work.
Right.
These laws are the guardians of the public trust. The underlying philosophy here is that public office isn't a right, it's a trust.
A trust. I like that.
And the law is incredibly strict about maintaining the appearance of propriety, not just the reality of it. It is about the integrity of the institution itself.
I was actually surprised by how specific it gets. Like, there are parts here that say you can't even agree to do something shady. You don't even have to succeed, or that you can't buy land in your own jurisdiction.
Exactly.
It's like the law is saying, we don't trust you to even be in the position to be tempted.
That's the perfect setup. It is a proactive defense system. It establishes boundaries not just for actions, but for relationships and interests.
Yeah.
So shall we dive into the first segment?
Let's do it. Let's unpack Article 213, Part A. The header here is frauds against the public treasury.
Right.
Now, usually when I think of fraud, I think of someone actively tricking someone else out of money. The classic, Nigerian prince email scenario.
Sure.
Or someone selling you a bridge they don't own. But this statute seems to be targeting something slightly different.
It is. This is what we might call the crime of the handshake.
The handshake. Okay.
Paragraph 1 of Article 213 is very specific. It deals with a public officer who enters into an agreement with an interested party or a speculator.
Okay, so let's break down the actor here first. It has to be a public officer, right?
Yes.
But can it be just any public officer? Like, if the janitor at City Hall makes a deal with the supplier to buy cheaper trash bags and pockets the difference,
Right.
does this specific article apply to the janitor?
That is a crucial distinction. The answer is generally no, not under this specific article.
Oh, really?
Yeah. The actor must be a public officer acting in their official capacity. But more than that, the source material emphasizes that acting in an official capacity entails a specific duty regarding the subject of the fraud.
A specific duty.
Yes. You must be the officer who has the duty to deal with the furnishing of supplies, the making of contracts, or the adjustment and settlement of accounts relating to public property or funds.
So you have to be the guy with the checkbook, or at least the guy holding the clipboard.
In a manner of speaking, yes, you have to be the one with the authority to actually influence the deal.
Got it.
If you are a public officer in the HR department and you conspire to fix a contract for road cement, you might be guilty of something.
Like general graft or something.
Exactly. Perhaps influence peddling or a general graft charge. But probably not Article 213 because dealing with cement isn't your official duty.
That makes sense.
The law targets the person who has the specific responsibility to protect those funds and chooses to betray that specific duty.
Okay, so we have our public officer with the clipboard. They have the power. Now, what is the act? The source mentions entering into an agreement. And this is where I got stuck.
How so?
Well, usually, a crime requires a result. I shoot the gun, the bullet hits. Here, it seems the agreement is the bullet.
This is where it gets really interesting, and this is your minefield analogy coming to life.
Yeah.
The law forbids entering into an agreement with an interested party or speculator regarding furnishing supplies, making contracts, or settling accounts.
Right.
But here is the crucial aha moment from the legal doctrine. The crime is consummated merely by entering into the agreement.
Wait, really? Let's stress test this.
Sure.
So let's say I'm the official. I'm the head of procurement. I agree to buy paper clips from your company at triple the price because we're buddies and you promised me a kickback.
Okay.
We shook hands on it. But then, before the payment goes through or before the paper clips are delivered, we get caught. Or maybe I get cold feet and cancel it the next day. Did I commit the crime?
You did.
Wow.
Under Article 213, the outcome is irrelevant. The government doesn't actually have to lose a single peso for the crime to be committed.
That is wild.
The crime isn't the loss of funds. The crime is the conspiracy itself, the agreement to defraud.
It's essentially pre-crime. It feels like something out of a sci-fi movie where you get arrested for thinking about doing something bad.
Right.
But here, the thought has manifested into a verbal or written agreement.
Exactly. It is distinct from theft or malversation, where the money usually has to move or disappear. Here, the law is attacking the intent and the breach of loyalty.
The breach of loyalty.
Yes. If you, as a public officer, agree to a scheme that is intended to defraud the government, you have already betrayed the public trust.
Yeah.
The damage is done to the integrity of the office, even if the treasury is still mathematically whole.
Wow.
The law is saying that the moment you shake that hand, you have ceased to be a public servant and have become a conspirator against the public.
I see. So it's about the conspiracy. It's about the alignment of the officer with the speculator against the state.
Correct.
Now, the source also mentions intent. I assume you can't accidentally stumble into this.
No, you can't.
Like, what if I'm just Terrible at negotiating.
That is a very valid question. The offender must have the specific intent to defraud the government.
Okay.
If you signed a bad contract because you were incompetent or just bad at math, or maybe you were just lazy and didn't check the market rates,
Right.
that might be an administrative issue. You might get fired for gross negligence.
Sure.
But it's not necessarily a crime under Article 213.
So incompetence is actually a defense.
In a criminal court, surprisingly, yes.
That's hilarious.
I mean, saying I'm not a crook, I'm just an idiot, can actually work here as a defense against Article 213.
Wow.
Because Article 213 requires that malice, that specific intent to cause damage or defraud the treasury.
Got it.
If you genuinely thought buying paper clips at 100 pesos a piece was a good deal, you are bad at your job, but you aren't a criminal under this specific section.
That's a relief for the mathematically challenged among us, I suppose. So that's the handshake. That's the backroom deal. Now, the outline moves us to Part B of Article 213, which I've dubbed the shakedown.
The shakedown, I like that.
Yeah, this feels different. The first part was about hurting the government. This part seems to be about hurting the citizens directly.
That's a very good distinction. We are moving from frauds against the treasury to illegal exactions.
Legal exactions.
Right. And here, the dynamic changes completely. We aren't talking about massive contracts for bridge building or office supplies anymore.
So who are we talking about?
We are talking about the public officer who interacts directly with you. The taxpayer, the license applicant, the small business owner.
Right. And the source material highlights a specific type of actor here. It says public officers entrusted with collecting taxes, licenses, fees, and imposts.
Yes. But there is a very important exclusion here that we need to clarify immediately.
Oh, right, because we might confuse some listeners who work in specific bureaus.
Exactly.
The source specifically mentions that this excludes officers of the Bureau of Internal Revenue and the Bureau of Customs.
Yeah.
Why is that? Are they allowed to do illegal exactions? That seems counterintuitive. Like if you work for the biggest collection agencies, the rules don't apply.
No, definitely not. It's not a get-out-of-jail-free card.
Okay, good.
It's simply that they have their own specific laws. The National Internal Revenue Code and the Tariff and Customs Code have their own penalty structures for these acts.
That makes sense.
And frankly, those penalties are often much stiffer and more specific to the nature of tax collection. So Article 213 doesn't apply to them because they are governed by those special laws.
Got it.
But the source explicitly cites Ganadin versus Belasco, noting that this article does apply to deputy sheriff.
Deputy sheriffs.
And other officers entrusted with collection duties outside those specific bureaus.
Okay, so if a deputy sheriff knocks on your door to collect a judgment fee, Article 213 is very much in play.
Yes, it is.
Now, looking at the text, there seem to be 3 specific ways you can mess this up. 3 flavors of illegal exaction.
Let's hear them.
The first one is demanding the wrong amount.
Right. This is the classic padding.
Tatting the bill.
Exactly. The crime is demanding, directly or indirectly, a sum that is different from or larger than what is authorized by law.
And again, does the money actually have to change hands?
Just like the fraud section we just discussed, the mere demand rule applies.
Mere demand rule.
The crime is finished or consummated once the demand is made.
Wow.
If I am the officer and I tell you the fee for this permit is 500 pesos, when the law says it's only 100 pesos, I have committed illegal exaction the moment those words leave my mouth.
Even if I refuse to pay.
Even if you refuse.
Even if I laugh in your face and walk away.
Yes. The demand itself is the abuse of authority.
That's intense.
You are using the weight of the state to try to squeeze a citizen. That attempt is the crime.
Because of the power dynamic, right?
Exactly. The law recognizes that the power dynamic is incredibly unbalanced. When an officer asks for money, the citizen often feels they have absolutely no choice but to pay.
Right. They're wearing a uniform or sitting behind a government desk.
Precisely. So the law punishes the officer for even asking for an unauthorized amount.
Now, there's a little note here in the source that says, if the officer collects the extra money and then spends it.
Ah, yes. The malversation twist.
The malversation twist. Sounds like a bad dance move.
It really does, but I'm guessing it's serious jail time.
It is. Very serious. If you demand the extra money, collect it, and then misappropriate it, meaning you spend it or use it for yourself, you have upgraded the situation. Upgraded it how?
Now, you aren't just looking at illegal exaction, you are likely facing malversation of public funds.
Wait, explain that. If I demanded extra money that wasn't legal, how is it public funds? Isn't it just stolen money from a private citizen?
That's a very keen observation. But the legal logic is this.
Okay.
Because you collected it under the guise of your official capacity, the moment that money hits your hand, you are holding it in trust.
Oh, wow.
Yes. If you fail to turn it over or if you spend it, you are malversing funds that, even if illegally collected, were collected under the color of law.
The color of law.
Right. It makes the situation significantly worse for the offender.
Okay, I want to get into a specific case study here because the source brings up U.S. versus Lopez.
U.S. versus Lopez.
It's about branding cattle, which feels like a very Yellowstone moment for our legal discussion.
It does.
But it clarifies a really tricky distinction.
It's a classic case because it draws a fine line between two crimes, illegal exaction and estafa.
Estafa, which is swindling.
Correct.
So set the scene for us. Why were they even branding cattle?
Well, back in the day, and still in many agricultural areas, branding cattle was a way to prove ownership and prevent rustling.
Right.
The municipality would offer a service to register and brand the cattle for a fee. It was a completely standard government service.
Got it. So enter Mr. Lopez, the municipal treasurer.
Exactly. Residents are coming in to register and brand their cattle. There is a legal fee for this service defined by the municipal ordinance.
Okay.
The treasurer, however, collects more than the legal fee.
Okay, so he's overcharging. That sounds exactly like a legal exaction. Based on what we just said, he demanded a different amount.
It usually is. But the court made a major distinction based on how he did it.
How he did it, okay.
The ruling says if the treasurer used deceit, if he tricked the people into believing the fee was actually higher.
Like showing a fake price list.
Exactly. Perhaps by showing a fake schedule or lying about a new law or claiming the cows were extra large and needed a double fee.
Extra large cows.
Right. If he uses that deceit, that is estafa. That is swindling.
Okay, so if he says, oh, didn't you hear the governor signed a new decree yesterday, the price is double now, that's estafa.
Correct. That is a crime of deceit. He is tricking the victim.
Right.
But if he simply used the weight of his office, if he says, I am the treasurer, give me 500 pesos.
It's just straight demand.
Right, without necessarily using a deceptive trick, but just relying on the intimidation or the authority of the position to compel payment.
Then what is it?
That is illegal exaction.
That is such a subtle nuance. So the law distinguishes between a liar and a bully.
Exactly. That is the absolute perfect way to summarize it. The liar commits estafa. The bully commits illegal exaction.
Both are crimes, obviously.
Both are crimes, but the mechanism of the crime is totally different. One relies on your ignorance, the trick.
Yeah.
The other relies on his power, the demand.
That helps clarify it a lot.
Okay.
Okay, let's look at type 2 of illegal exactions. The no receipt violation.
This one sounds bureaucratic.
Yeah, it sounds like, oh, I forgot the receipt, big deal.
But it is fundamental to transparency. The crime here is failing voluntarily to issue a receipt for officially collected money.
Failing voluntarily. That means you chose not to give one.
Yes.
Not that you ran out of paper or the printer jammed.
Correct. It implies a willful omission. And why does this matter?
Why does it?
Because receipts are the only paper trail we have in a cash-based interaction.
Right.
If a deputy sheriff, as mentioned in Ganadin versus Belasco, collects money and doesn't issue an official receipt, that money effectively becomes invisible.
It's the first step towards pocketing it.
Exactly.
It's ghost money. If there's no receipt, it never happened.
Precisely. The law criminalizes the failure to issue the receipt to stop the theft before it even starts.
That's smart.
You don't have to prove the sheriff stole the money to get a conviction here. You just have to prove he took the money and didn't write the receipt.
It lowers the bar for catching corruption.
It's a preventative measure. It says, if you want to handle public money, you must create a record.
Yeah,
If you don't create a record, you are already a criminal.
got it. And finally, type 3, the wrong currency.
This is collecting objects of a nature different from what the law demands.
So if the fee is 100 pesos, and I say, I don't have cash, but here is a really nice chicken.
If the law demands cash, the officer absolutely cannot accept the chicken.
But why? If the chicken's worth 100 pesos, maybe it's a prize-winning chicken? What's the harm? The government gets value.
It preserves the sanctity and objectivity of the transaction. If officers start accepting payment in kind, It opens the door to subjective valuation and eventually widespread corruption. Who decides what the chicken is actually worth? You could easily say, oh, that wasn't a 500 peso bribe. It was just a very expensive chicken.
Right.
Or I'll waive your fee if you come paint my house this weekend.
So services too.
It blurs the line between public duty and private benefit.
Exactly. The law cuts that off by saying, collect what the law says to collect. Nothing else.
No chickens, no painting fences, no personal favors, just the authorized fee.
It really is about removing the wiggle room.
That is the perfect phrase for it, wiggle room.
All right, moving on. We've covered the handshake, which is Article 213A, and the shakedown, which is Article 213B. Now let's talk about what happens when an officer just goes full con artist. Segment 3, Article 214, other frauds.
This is a short but incredibly powerful article.
Okay.
It links the public officer to the general crimes of swindling, or estafa, and deceit, which are found later in the code, Articles 315 to 318.
So, estafa is a crime anyone can commit, right? I can commit estafa against you right now. I could try to sell you a bridge I don't own.
You could try.
So why do we need Article 214? Why not just charge them with estafa and be done with it?
Because of what we might call the multiplier effect.
The multiplier effect.
Yes. If a public officer takes advantage of their official position to commit these standard crimes, Article 214 imposes additional penalties.
Additional penalties.
It essentially says, we're going to charge you with estafa, and we are going to add a special penalty because you are a public officer.
It's an aggravating factor.
Essentially, yes. It's saying you are a swindler, which is bad, but you are a swindler wearing a badge, which is worse.
The outline gives us a two hats analysis here, comparing two cases, U.S. versus DiCucci and U.S. versus Torta.
Yes.
Both involve counselors, right? This comparison really helped me understand the boundary.
It's a vital comparison for understanding the official position element, because public officers are also private citizens.
Right, they have lives outside of work.
Exactly. So let's start with case A, DiCucci.
Okay, what happened in DiCucci?
In DiCucci, a counselor committed estafa. However, the court found that he did it purely as a private individual.
So he didn't use his influence as a counselor?
No. He didn't promise anything related to his office. He just happened to be a counselor while he was scamming someone.
Maybe selling a horse or a piece of land privately that had nothing to do with the municipality.
Precisely.
So the result?
He was punished for estafa, but not under Article 214. The additional penalties didn't apply because he wasn't wearing his public officer hat during the crime.
He was just a private citizen breaking the law.
Right. The fact that he was a counselor was coincidental to the crime.
Okay, now compare that to case B, Torta.
In Torta, the counselor explicitly used his position to commit the estafa.
How so?
He likely leveraged his authority, his title, or his access to facilitate the swindle.
Like saying, trust me, I'm a counselor.
Exactly. Or he used his office to make the lie more believable. Or perhaps he promised some government favor that he never actually intended to deliver.
And the result's there.
Article 214 absolutely applies. He gets the extra hammer of the law.
So the lesson here is, the law punishes the abuse of the public trust more severely than the crime itself.
Yes.
Being a criminal is one thing. Being a criminal, utilizing the tools the public gave you, is another entirely.
It's the difference between a crime of opportunity and a crime of betrayal. Article 214 is there to punish the betrayal. It's about the weaponization of the office.
That makes perfect sense. And it leads us perfectly into segment 4. We're moving from con artists to white-collar prohibitions.
Article 215. Prohibited transactions.
This feels a bit more Wall Street, doesn't it?
It does. This is about the speculator.
Who exactly is the target here? The outline specifically notes appointed public officers.
Yes, the source material highlights that this applies to appointive officials.
So these are people appointed to their roles, not necessarily elected officials.
Think of cabinet members, bureau directors, people chosen for their expertise or administration.
And what are they forbidden from doing?
They are forbidden from becoming interested, directly or indirectly, in transactions of exchange or speculation.
Speculation, that's a loaded word. How does the law define that? Because almost everything financial has some risk.
In this context, it generally includes buying and selling stocks, land, or other commodities with the hope of taking advantage of a rise or fall in price.
Okay.
It implies a short-term, profit-seeking behavior based on market fluctuations.
But wait, does that mean a public officer can't have a savings account? Or buy a house to live in? That seems incredibly restrictive.
It would be, but
Like if I'm appointed as a director, do I have to freeze all my assets?
no. And the source material makes a very important distinction here. The investment versus speculation nuance.
Okay, lay that out for me.
Purchasing a stock or a share alone is simply an investment that is generally allowed.
Right.
Buying a home for your family is allowed. Buying a government bond is allowed.
So buying Apple stock and holding it for 10 years is fine.
Correct. That is investing.
Okay.
But if you are regularly buying securities for resale, flipping them for profit, that is speculation.
I see.
The source cites Reyes, a prominent legal authority, saying, an appointive public officer, in effect, cannot devote themselves to commerce.
That is a harsh line. Cannot devote themselves to commerce. It sounds almost monastic.
It goes back to the philosophy we discussed at the start. Why ban this? There are really two main reasons.
What's the first one?
One, to prevent officers from manipulating markets they might have inside information on or regulatory power over.
Right.
If you know a new law is coming that will hurt the tech sector and you short sell tech stocks, you are misusing your position.
That's basically the insider trading argument.
Right. But reason two is simply to prevent their attention from being divided. If you are glued to the stock ticker day trading, are you serving the public?
No, you're supposed to be working for us, not checking your portfolio every 5 minutes.
Exactly. It ensures that your primary loyalty and your primary energy are directed toward your public duties. The public pays your salary, they deserve your full attention.
There's another rule in here that I found really curious, the geography rule.
Yes. The geography rule.
What's the deal with that?
The transaction must take place within the territory subject to the offender's jurisdiction.
So if I'm an appointive officer in Manila, I can't speculate on land in Manila.
Right.
But can I speculate on land in Cebu?
Textually, it implies that the prohibition is tied to your specific jurisdiction.
Okay.
The danger is highest where your power is. You can manipulate land prices in your own city through zoning laws or permits or infrastructure projects.
Oh, like deciding where the new highway goes.
Exactly, which
Yeah.
makes the adjacent land skyrocket in value.
Right. So if you buy the land, then build the highway.
That is the ultimate conflict of interest. But you probably can't do that in a city on another island where you have no authority.
Because you can't influence the zoning board in Cebu if you work in Manila.
Exactly. So the law restricts the prohibition to the area where your influence, and therefore the temptation, is real.
That makes perfect sense. It's about where your influence actually lies.
Precisely. It limits the prohibition to the area where the conflict is most likely to exist.
Which brings us to the final and perhaps the broadest segment of our deep dive today. Segment 5, Conflict of Interest and Prohibited Interests, Article 216.
This is the catch-all. This is where the net is cast the absolute widest.
The concept is possession of prohibited interest.
Right.
And it seems to group people into 3 distinct categories. Let's tackle group 1 first. Public officers intervening in contracts.
The elements here are straightforward but very strict. You need a public officer. They become interested in a contract or business. And this is the key. It is their official duty to intervene in that contract.
The case study here is U.S. versus UDART.
Yes, the famous case of the municipal fish ponds.
I love how these old cases are always about cattle or fish ponds. It really paints a picture of the economy back then.
It was a simpler time, but the principles are entirely timeless. In UDARB, a municipal mayor took a direct part in the lease of municipal fish ponds.
Okay.
Now, as mayor, he has a duty to oversee those leases, to make sure the town gets the best deal, that the process is fair, that the fish ponds are managed correctly.
But he wanted the fish pond for himself.
Or he had a financial interest in who got it. Maybe he was a silent partner.
Oh, tricky.
The court laid down the possibility doctrine here, which is a fascinating legal standard.
What is the possibility doctrine?
It states that actual fraud is not required.
Wait, really?
The government doesn't need to prove that the mayor got a cheap price or that the town lost money. The mere possibility that he might prefer his personal interest over the government's interest is enough to convict.
Wow. So just being in a position where you could cheat is the crime if you have an interest in the deal.
Yes, because the law presumes that you cannot serve two masters.
Right.
You cannot be the seller representing the public and the buyer representing yourself at the exact same time. The conflict is inherent.
You just can't be neutral if your wallet is involved.
Even if you are a saint, the law says we don't believe you can be impartial here.
That is a remarkably high standard. It totally removes the burden of proving actual theft and focuses entirely on the relationship itself.
It does.
Now, Group 2 is interesting because it brings in people who aren't traditional public officers. Experts, arbitrators, and accountants.
Right. Imagine you are hired by the court or the government to appraise an estate. Let's say a large hacienda that is being divided up in a legal dispute.
Okay, so I'm the appraiser. My job is to say, this land is worth 10 million pesos.
Exactly. The crime here is taking part in a transaction regarding that specific property.
So I can't value the house at 2 million pesos and then turn around and buy it myself.
Precisely. That is the exact scenario the law prevents.
Oh, wow.
If you are the expert adjudicating or appraising the property, you cannot buy it. You cannot have an interest in it.
Because if you did, you would be incentivized to undervalue it to get a good deal for yourself.
It destroys the integrity of the appraisal.
It effectively bans insider trading for appraisers.
In a way, yes. It preserves the neutrality of the expert. If the umpire bets on the game is rigged.
The law says the expert must be disinterested.
Exactly.
And Group 3, guardians and executors.
This creates a bridge to the private sector, but operates under the exact same principle.
Okay.
Guardians and executors have a fiduciary duty to their wards, or the estate. The law treats the breach of this trust similarly.
Meaning, you can't use your position as a guardian to buy the orphan's property for yourself.
Right. It's arguably even more heinous because the victim, the ward, often cannot speak for themselves.
It seems like the common thread across all of these, from the mayor to the appraiser to the guardian, is the protection of the vulnerable party.
The public, the court, the orphan, absolutely.
It is about protecting those who cannot protect themselves against the person holding the power.
The law steps in and says, because you have power over these assets, you cannot own them.
Now, before we wrap up this section, the outline mentions constitutional connections. This isn't just in the Revised Penal Code, right? This concept goes all the way up.
It does. If you look at the 1987 Constitution, you see these exact same principles scaled up to the highest offices in the land.
Wow.
Section 14, Article 6 applies to senators and congressmen.
Right.
Section 13, Article 7 applies to the president and the cabinet.
And Section 2, Article 9 applies to the constitutional commissions.
Exactly.
And what do those sections broadly say?
They broadly prohibit financial, business, or professional interests that create a conflict. For example, cabinet members are strictly prohibited from practicing their profession or participating in any business.
So the president can't run a construction company on the side.
Definitely not.
Yeah.
The theme is consistent from the municipal mayor and his fish ponds all the way to the president in Malacañang.
High office requires severing financial ties that create conflict.
You have to choose. Do you want to be rich in business or do you want to wield public power?
You generally cannot do both simultaneously in a way that mixes them.
Right.
You have to choose. That is a really powerful sentiment. It frames public service as a sacrifice of certain private liberties.
It is the absolute core of the law.
So let's synthesize all this. We've been on quite a journey today.
They really have.
We started with a handshake, Article 213, where just agreeing to a bad deal is a full-blown crime.
Then we looked at the shakedown, illegal exactions, where we learned the crucial difference between a liar and a bully. Estafa versus illegal exaction.
We saw the ghost money of missing receipts.
We looked at Article 214, where a public officer swindling someone gets hit with a heavy multiplier effect.
And Article 215, the white-collar ban on speculation.
And finally, Article 216, the broad net catching any conflict of interest, from mayors down to appraisers and guardians.
When you look at it all together, the reflection you mentioned at the start is spot on. The law is really trying to legislate integrity.
But more specifically, it is trying to remove the opportunity for corruption. It basically doesn't trust human nature. It says, we know that if you are allowed to buy the land you are zoning, you will eventually be tempted to zone it in your favor.
So we are just going to ban you from buying it in the first place.
It safeguards the officer from themselves, in a way.
And it protects the public's belief in the system. Because if the public sees the referee betting on the game is over.
Even if the referee tries to be fair, nobody will believe it. These laws are fundamentally about keeping the referee from betting.
That brings us to our closing thought. We always like to leave you with something to chew on. And I'm thinking about Article 215, the ban on speculation.
The fine distinction between investment and speculation.
Right. We established earlier that buying and holding is okay, but trading for profit is not. But we are living in a world of Robinhood apps, crypto exchanges, and 247 markets right on our phones.
It's a blurrier line than ever before.
Exactly. If a public officer buys Bitcoin, is that an investment? Or because crypto is so inherently volatile, is it automatically speculative?
That is a completely fascinating question.
If they use an automated trading bot on their phone while they're sitting in a session of Congress, are they devoting themselves to commerce?
The law was written for a world of slower markets, of telegraphs and paper stock certificates.
Right.
In a world of instant gratification and high-frequency trading, where does the line between saving for the future and commercial speculation actually lie?
It's tough.
It's a question that modern courts and legislators will likely have to grapple with very soon.
Definitely something to think about.
Indeed.
So the next time you interact with a government office, look around. Look for the receipt. Check the jurisdiction.
And remember, the law is working hard in the background to keep that transaction clean.
Thanks for joining us on The Deep Dive.
Until next time.
Welcome to the debate. Today we are walking a razor's edge, really. We are looking at that precise and honestly often very blurry line where a public duty ends and criminal liability begins. Specifically, we're dissecting the Revised Penal Code, looking at Articles 213 through 216. These are the laws governing frauds, illegal exactions, and prohibited transactions.
Yeah, it really is a fascinating area of the law, mostly because it forces us to grapple with a really uncomfortable question, which is how much of a public officer's private life and their private judgment do we actually criminalize in the name of integrity? Because these articles, they don't just punish outright theft, they punish agreements, they punish, the failure to issue a paper receipt, and they even punish the mere possession of a financial interest.
Right. And for good reason. My position today is pretty straightforward. Public office is a strict fiduciary trust. The law, particularly Articles 213 and 216, correctly penalizes the breach of that duty and the mere possibility of fraud. We just cannot wait for the treasury to be empty before we act. The law has to be a wall, not a suggestion.
And I come at it from a slightly different angle. While I obviously agree that corruption is a cancer, strict liability, especially when we start talking about Articles 214 and 215, risks turning basic financial competence into a crime. We really have to distinguish between a truly corrupt official and a private citizen who just happens to hold an office. If we interpret these laws too broadly, we end up criminalizing standard investment and, frankly, private error. And that helps absolutely no one.
Well, let's get right into the thick of it with my opening position. I think we really need to look at the architecture of Article 213 regarding frauds against the public treasury. Because the genius of this statute is that it is entirely preventative. It targets the intent and the agreement rather than waiting for the damage to actually occur.
How so? I mean, how does it effectively do that without overreaching?
Look at the elements regarding furnishing supplies or making contracts. The law explicitly says the crime is consummated by merely entering into an agreement to defraud. The outcome, completely irrelevant. If a public officer, acting in their official capacity, sits down with a supplier and agrees to a scheme, say, to inflate prices or accept substandard goods, the crime is done.
Right, but
we don't need to wait for the money to be transferred. We don't need to wait for the substandard concrete to actually be poured. The conspiracy itself, that breach of loyalty, that is the crime.
Sure, but official capacity is doing a lot of heavy lifting in that scenario.
It is, and rightfully so. The law defines this as having a duty to deal with the settlement of accounts or contracts. If you have that duty and you use it to rig the game, you have violated the public trust. The law effectively removes the wiggle room. It implies that an officer really cannot separate their intent to defraud from their power to execute it. By punishing the agreement, we protect the treasury before a single centavo is ever lost.
Okay, that's a compelling argument for the worst offenders, definitely. But let me give you a slightly different perspective. When you take this prevention at all costs mentality and you apply it to something like Article 215, things get incredibly murky. Article 215 deals with prohibited transactions, specifically regarding speculation.
Which is necessary to prevent insider trading by public officials.
In theory, yes, but look at the text of the law. It punishes an appointive public officer who becomes interested in transactions of exchange or speculation. But the legal commentary, Reyes specifically, makes a distinction that is, frankly, incredibly difficult to navigate in the real world. It says that purchasing stock alone is simply investment and is legal. But if you buy securities regularly for resale for profit, it suddenly becomes speculation and is a crime.
Right, because the latter implies you are distracted from your duties, or worse, using your specific knowledge for quick gain.
But where exactly is the line? At what point does a smart retirement strategy become a criminal act? The commentary explicitly says, appointive public officer, in effect, cannot devote self to commerce. That is a massive restriction on personal liberty. It basically suggests that if you are good at reading the market, you might be going to jail. It treats the financial acumen of a private citizen as a threat to the state, simply because they hold a government job. That isn't protecting the treasury. That's policing the private wallet.
I see why you think that, but I would frame it differently. The restriction isn't about punishing financial literacy at all. It's about undivided loyalty. The state is essentially buying your exclusivity. But, this actually brings us to our first core area of debate today, the nature of exaction under Article 213, and just how strict the law really is in practice.
Go on.
So under Article 213, we deal with illegal exactions. This is where the law becomes that rigid wall I mentioned, and I argue it absolutely must be. If an officer entrusted with collecting taxes or fees demands an amount different or larger than what is authorized, the crime is consummated. Full stop.
Even if they don't keep the money?
Exactly. Mere demand suffices. If they keep it or spend it, as we saw in the case of People versus Policher, that adds malversation, which is essentially embezzlement, to the charge. But the exaction is the demand itself, and it actually goes further than that. Even the mere failure to follow procedure is criminalized. Look at Ganadin versus Belasco.
Ah, the deputy sheriff case.
Yes. Let's look at the facts there because they are crucial to understanding this. A deputy sheriff received amounts in connection with his duties, but failed to issue official receipts. The court didn't ask if he stole the money. They didn't ask if he intended to return it later. They ruled that failing to voluntarily issue the receipt as required by the National Accounting and Auditing Manual was an illegal exaction. This protects the paper trail. Without this level of strictness, audit trails just vanish.
I'm not entirely convinced by that line of reasoning, mostly because it ignores the actual nature of the interaction. You're painting with a very broad brush here. If we look at the jurisprudence, specifically U.S. versus Lopez, the courts actually care deeply about the method used, not just the result.
Lopez was the case regarding the branding of cattle, correct?
That's right. You had a municipal treasurer who collected greater fees than the law prescribed for registering and branding cattle. By your logic, that is a textbook illegal exaction. He asked for more than the law allowed. But the court said no. Why? Because he used deceit. He tricked the residents into believing the higher fee was the actual legal rate. And because there was deceit, the crime was estafa, swindling, not illegal exaction.
But he was still punished. He still went to jail.
He was, but the legal distinction matters immensely for our discussion today. It proves that taking advantage of office is a highly complex variable. If the method is deceit, the charge changes entirely. This suggests the law values the method of the crime over the mere status of the officer. You want the law to be a rigid wall, where officer plus wrong amount equals crime. But the courts are saying, wait, was he acting as a tyrant, demanding tribute, or a con man tricking a victim? Those are fundamentally different moral failings, and the law treats them differently.
That's a really interesting point. You're saying the tyrant demands payment because they have the power, whereas the con man demands payment by lying about the rules.
Precisely. In Lopez, the treasurer acted like a private swindler who just happened to have a government desk. He deceived the people regarding the cost of the branding. In a true illegal exaction, the officer doesn't need to deceive. They just rely on the fear of their authority. The victim pays because they are afraid of the badge, not because they were tricked by a lie.
Right, but doesn't that actually reinforce my point? Whether it's estafa or exaction, the common denominator is still the abuse of the public position. The Lopez ruling doesn't exonerate the officer. It just reclassifies the sin. But your mention of the con man versus the tyrant leads us perfectly into the second major tension here. Article 214 and the struggle to separate the private from the official capacity.
And this is where I think the advocate's position is at its weakest. Article 214 applies other frauds to public officers, adding extra penalties. But there is a very strong argument that a public officer is still a citizen with private rights.
A citizen who carries the weight of the state.
But not 24/7. Let's look at U.S. versus Dakikui. Here you had a counselor, an elected official. He committed estafa. He swindled someone out of money. But the court ruled that the additional penalties of Article 214 did not apply.
And why was that?
Because he did it as a private individual. He did not receive the money in the exercise of his official functions as a counselor. He was just a guy who happened to be a counselor committing a crime. This really validates my core belief. The law must respect the boundary between public and private. We cannot treat every action of a public servant as an official act. If we do, we create a class of citizens who are somehow more liable than anyone else for private mistakes.
I'm sorry, but I just don't buy that. Let me tell you why. You are citing Dakaku, but you are conveniently stepping around U.S. versus Torida.
I expected you'd bring that up.
Well, it's the perfect counterweight. In Toridata, we also had a counselor committing estafa, but in this case, the court did apply the additional penalties of Article 214. Why? Because he took advantage of his official position to commit the fraud. He used his influence as a counselor to facilitate the swindle. He essentially said, "Trust me, I'm a counselor," to get the money.
But that proves my point. There is a distinction. The court looked at the facts and said, here, the office matters. In Daukukui, it didn't. It shows that the office is not a permanent stain on the person.
I think it proves that the distinction is razor thin and almost impossible to police without strict enforcement. In Torpeda, the court recognized that his influence as a counselor was the actual mechanism of the fraud. My argument is that it is incredibly difficult for an official to truly switch off their influence. When a municipal councilor walks into a room, are they a private citizen or are they a counselor? The influence is pervasive. That hat doesn't just come off because they say so.
But it must come off, or else we are saying that a public officer has zero private autonomy. I mean, if a mayor sells his personal car to a neighbor and there's a dispute over the engine, is that corruption? Or is that just a civil dispute? Under your pervasive influence theory, everything they touch is tainted by their office.
If the neighbor buys the car because he fears the mayor's power, then yes, it is tainted. We have to be realistic about power dynamics. A public officer is never just some guy to the people in their jurisdiction. The potential for coercion exists even in quote-unquote private transactions. That is exactly why the law has to be so cynical.
That mindset leads to a complete paralysis of the individual. But let's move to where the law actually agrees with you most strongly. This is probably the hardest hurdle from my side of the argument. Article 216, possession of prohibited interest.
Ah, yes. This is where the law stops being reactive and becomes purely prophylactic. It's the ultimate safeguard.
The conflict of interest statute.
It's more than that, really. It is a prohibition on temptation itself. Article 216 punishes public officers who become interested, directly or indirectly, in any contract or business in which it is their official duty to intervene. And here is the clincher. U.S. versus Udarabe.
The fish pond lease case.
Correct. Let's lay it out. A municipal mayor took a direct part in the lease of municipal fish ponds. Now, he might argue the lease was totally fair. He might argue the town made money, but the court held the actual fraud is not required. The mere possibility of fraud or the mere preference of personal interest over the government suffices to convict.
That is a very high bar. Mere possibility?
It is the only bar that works. The court recognized that you cannot serve two masters. If you have a duty to intervene, to approve the lease, to check the contract, and you have a slice of the pie, you are guilty. It doesn't matter if you are a saint. The law assumes that a public officer with a conflict will eventually choose themselves over the state. And it applies to everyone, experts, arbitrators, even private accountants regarding estates they appraised. If you participated in the adjudication, you cannot touch the property.
That's a compelling argument. And regarding the mayor in the fish ponds, I completely agree. He controls the lease, he takes the lease, that's a clear, undeniable conflict. But if you consider the speculation trap regarding Article 215 again, you talk about udarbe, which is clear-cut, but Article 215 and the definition of speculation creates a massive trap for the innocent.
How so? We touched on this earlier, but I still don't see it as a trap. I see it as a necessary boundary.
Let's drill down into it. The law applies to transactions of exchange or speculation within the officer's jurisdiction, but remember the jurisdictional nuances of the code itself. Article 213 applies to deputy sheriffs, as we saw in Ganadin, but the notes explicitly say Article 213 does not apply to officers of the Bureau of Revenue or Customs.
Right, because they are governed by special codes, the National Internal Revenue Code and the Tariff and Customs Code.
Exactly. So we have this patchwork. If I'm a sheriff and I fail to issue a receipt, I'm under the Revised Penal Code. If I'm a customs officer, I'm under a different book entirely. And if I'm an appointive officer trying to buy land or stocks, I have to worry if my purchase is classified as an investment or speculation. The udarbe standard of mere possibility of fraud is genuinely terrifying when applied to this patchwork system. It suggests that the safest course of action for any public officer is to be financially paralyzed, to own nothing, to trade nothing.
Or simply to divest from areas where they have power. That is just standard ethics. If you are the mayor, don't buy the fish pond. If you are the treasurer, don't trade in local currency bonds. It's not paralysis, it's hygiene.
But jurisdiction can be incredibly broad. If I'm an officer in a province and I buy land in that province hoping the price goes up, is that speculation? Am I using my official capacity to know where the new road goes? Maybe. Or maybe I'm just a guy buying a lot for his kids. The strictness you champion in udarbe assumes the worst of every single transaction. It assumes guilt before the act.
It assumes fallibility. That is the core of my argument. The law knows that human beings, even experts, are fallible. We punish the possession of the interest because we know that once the interest exists, the judgment is compromised. You call it financial paralysis, I call it the price of public service. When you take the oath, you accept that your financial life is now under a microscope.
And I call it a barrier to entry. If we make the rules so strict that a competent person cannot manage their own portfolio or make a private mistake without facing criminal charges, who are we left with? We might end up with officers who are simply too scared to act, or conversely, those who have absolutely nothing to lose.
Well, let's look at the experts section of 2116 again, because this supports my view that the law is about knowledge as much as power. It includes arbitrators and private accountants regarding estates they appraised. Why? Because they know the real value. They have inside information.
And I agree with that application. That is trading on insider information, but that is fundamentally different from the broad speculation ban in 215. The expert regarding the estate has specific, non-public knowledge. The appointed officer buying stock might just be reading the newspaper like everyone else.
But if they are buying regularly for resale, they are devoting themselves to commerce. You can't run a day trading operation from a government desk. That is a distraction from public duty. The state pays for your full attention. If you are watching ticker tapes, you aren't watching the Treasury.
But again, that's an HR issue. That's a labor dispute, not a criminal one. Fire them for not working, sure. But to label them a criminal under the penal code for speculation? That feels like a massive moral overreach. It equates checking a stock price with literally stealing from the vault.
It's treating the public trust as sacred. If you are serving the public, your commercial ambition must be put on pause. That is the trade-off. You cannot be a servant of the people and a servant of the market simultaneously. The conflict is inherent.
I think we are circling the same fundamental disagreement here. You see the officer as a vessel of the state 24 hours a day. I see the officer as a citizen who wears a uniform for 8 hours.
And the law, particularly in Torita and udarbe, suggests that uniform is practically stitched to the skin.
While Dakuku suggests it can in fact be taken off.
And that contradiction is exactly why this debate is so necessary. As we wrap up, I want to summarize my stance. Articles 213 through 216 are essential because they attack the root of corruption. We don't wait for the tree to bear poison fruit, we dig up the seeds. The agreement to defraud, the failure to issue a receipt, the possession of a conflict of interest, these are the seeds. The law must assume that a public officer with a conflict will eventually fail. Therefore, the law removes the option to fail.
In Dakyukui and the official fraud in Torida matters, we must be vigilant not to punish public service by stripping officers of their private rights or mislabeling their intent. If we treat every investment as speculation and every mistake as a crime, we don't end corruption, we just end the willingness of highly competent good people to serve.
It creates a system that tries to legislate morality and loyalty.
A high bar, indeed.
It leaves us with a legal framework that is incredibly demanding, complex, and occasionally contradictory, but it is the framework we have to safeguard the public trust.
It is a framework that every public officer needs to deeply understand, right down to the fine print of every receipt and every stock purchase.
Absolutely. There is always more to explore in the material, but that's all the time we have for this session.
Thanks for listening to the debate.